Well, thank you, folks, for your interest in meeting with us today. We're going to talk about uh, grain market outlook for 2023-24. I'll start out for about plan is for about 10 minutes to talk about how the marketing strategies that we've been following in a example sense, in a learning sense, over the last summer, well, from winter through summer, how they've worked out or not. And we'll focus particularly on the feed grains and on soybeans on that. And then Guy Allen will talk about international grain market factors that are certainly impacting the U.S. That'll be about 10-15 minutes, and then we'll finish up and talk about. I think I really want to talk today about a lot about corn and soybean markets, because they're the ones that the crop information, well, that the concerns about crop production prospects are most I guess most prevalent for us, and have the most possibility of actually moving the market. So we'll focus on that. I also have information, as time allows, on the wheat market, grain sorghum, and on cotton. So let's dive right in. Uh, so we've been involved starting in January on a series of workshops and follow-up webinars on what we'd call the Winning the Game project. That we work with people at the University of Minnesota, and a pretty common educational tool used throughout the Midwestern states. We brought it into Kansas. Mark Nelson with Kansas Farm Bureau and myself been putting on these workshops, and so we've looked at I've done workshops on wheat, on soybeans, on corn, and on grain sorghum in the last 2 or 3 years. So let's look at the results of these 2023 feed grain, soy and soybean plans, and also get to talk just a little bit about where we might be going for 2024 wheat. So when you look at the feed grain plan, and we're kind of lumping corn and sorghum in together, really just with a basis differential. Although you look at the market, sometimes that difference, depending on the day, isn't much. You can see that in terms of the percent of grain priced following the daily Dees 2023 corn futures, you can see that the up until basically about within the last here in July, the highest price for the year was the first day of January, 607. And then we were tending down on that, and then combination of factors came in. Some of it Ukraine's, a lot of it concern about production came in and affected us. So you can see the percentage of the amount of grain that we'd identified that we were out of our total amount of grain that we were going to price adds up to, you can see 20% on March 29th at 570, another 20% on April 18th, 571. And note that the markets were moving their way down. We ended up, and we were basically out of the activity until prices came back up again and and reached our cost of production range, which is about 560, 570. Now, arguably, that's a pretty high range, given the cost of productions that Kansans typically face. But we thought we'd put it there and follow through on it. And then June 15th, another 30% priced at 575. So we priced that on the way up, priced on the way down, and have been out of the market since that time. Now, note, with the recent run up here of late, there maybe we'll come back up into that range, but so far you've got basically 100%. You have 100% of what we had intended to market on a pre-harvest basis. Actually worked out that we had the market situations that came to fruition. Average 577 as a Dees futures position, up 43 cents from other measures we were looking at. Okay, let's see here. There we go. So in looking at this, where we stand, Forward cash contracts, in essence, we're done. Now, for the futures and options, we have open positions that on paper that we still have to close out of, just a matter of the time. And for the contracts, you can see as we followed this, Topeka, Salina, Garden City, pricing moves. You can see the basis levels, and on in brackets, those are negative basis levels. And again, these were harvest delivery. We had and as is common now in Garden City, a 30-cent over basis composite break even of 550. So in general, we're covering break even costs. And when we put down a break even cost, we're looking at not just the cash transactions of fertilizer, et cetera. We're trying to look at a full economic cost break even. So we've got money for living, capital expenditures, all that in there. So we just need to grow the crop and need to grow the crop and deliver for this on the futures. Excuse me. There we go. On the futures hedges, you can see we have 4 separate future sales as we work this out. 570, 571, 575, and 588. And then, so on that, again, that's a typical hedging situation. So we have a open account. You can see prices have fallen off. You can see how much we have in terms of equity in those futures positions. So we'll close those out at a time in the future here. We could carry them all the way to the end. We'll see. Close them out and then sell the commodity at the harvest price. So it's just a matter of closing things out. It's interesting to me to look and see with that 550 break even, what now are we seeing for corn in terms of forward contract bids? So you can see the harvest cash price. Really, there's nothing there other than maybe near Garden City that comes near the break-even price for corn. Everything's below that. So according to this, what we'd seen earlier this week, we wouldn't be pricing anything. For grain sorghum, just take note, we do see some things happening in the sorghum market. See the Salina for new crop bids over the corn bid. Same situation in Hutchinson, even elsewhere. So even in Topeka. So some export movement coming in and helping sorghum. I would say for soybeans, you can see a pretty similar situation. We've got so here you can see the percentages and when we priced. The average price of 13.24 as a November's position, November futures position. Our cost of production about 12.60. It's interesting. You look at those prices, and now you see where we stand as we move forward. So again, we're cash contracts were done. Futures just have to, same situation for corn. We have to close out the futures positions and then sell at harvest. So composite break even about $12. So you look there now and just go back a second. So our average price about 13.24 CME futures. Take a basis off of that, and you've got so right now you have 1392 is where November, at least yesterday, where it closed out at with concerns about the crop. New crop bids, you can see the basis levels across the state for beans. So we're running it's about a break even to a little bit of a loss on our pre-harvest gains. I remember all of our thoughts coming through the winter was that, gosh, we're going to get a tremendous South American crop. We really are fearful of where prices could go. And we did get that crop, but we weren't counting on our own crop being at risk right now. And we're looking forward to wheat. I just put this up here. This is just more generalities. We had marketed last year's wheat, didn't have a lot of pre-harvest pricing opportunities. We had a pretty high cost of production. I think we were up at $7.50 to $8 or more for a break-even cost, and so I think we priced about 47%, 50% of the grain on last year's crop. So now we're coming into this, of course, this marketing year. The marketing year actually runs June 1, 2024 to May 35th, 25. Well, we're looking at the crop that we're going to be seeding this fall. We'll harvest in July of next year and then market it. But We if you have good crop insurance and feel comfortable accepting the risk, there are some pre-harvest things that can be done. And just note, um, these uh, these costs here across the state at these major locations, they're not far off of where we're at for break-even numbers for wheat. And uh, those of you that have a lot of years of experience, you'll recognize that. Gracious. So we're talking about break-evens around $6.50 to $7. With inflation, that's where we've gotten to. We're coming out with our updated K-State budgets, the lower fertilizer prices. We'll factor in on that, and perhaps we'll see something closer to 5.5. We'll see, but these are the bids we're seeing right now for new crop 2024. One other factor to consider is what the crop insurance situation is, and we're in the price discovery period right now for the 2024 winter wheat crop in Kansas. 744 is the average price for July 2024 so far, and you can see the specifics. Last year, we were for 2023 crop, we were at this time we were looking at about $1.30, $1.40 higher, 8.79. So I don't know that will discourage people from planting wheat, but it doesn't encourage them either. So our reference price is kind of what we had last year, and it's certainly lower. So, Guy, with that, why don't I stop sharing? You can come on and talk about your factors.
Dan asked me to speak a bit about the international situation and some macro issues today. Not going to have time to go through all this. I want to touch base on some geopolitical issues. I want to drill down a bit and take most of my time talking about the macroeconomic situation, the U.S. dollar and the exchange rate. And if we have time, touch base on ocean freight there in a few minutes. Just a quick glance around the world. We have the obvious situation of the Russia-Ukraine conflict continues to be forefront in the market as that impacts trade flows out of the Black Sea. Something that's adding a lot of uncertainty, and which I'm probably more concerned of, is the China tension on the South China Sea situation. That seems to maybe have starting to cool off a bit, particularly as China's economy starts to show signs of struggling. And I wouldn't be surprised if they sort of move into recession, and that has impacts particularly on demand. And we'll get to that in a bit. There's increasing government food security around the world, as we're seeing from a number of places around the world, and particularly as the financial situations, most recently in places like Pakistan, Sri Lanka, Argentina. That's what I want to talk a bit, as those exchange rates start to collapse, causing some real problems there. So just skipping on forward to macro issues, and this is the topic I wanted to spend most of my time on today, is talking about the U.S. dollar index, its value, and how that impacts commodity prices, and how that particularly impacts our exports. Exports for U.S. grain, particularly wheat, has been very, very soft and very, very slow. Now, what we're looking at this particular chart is the U.S. dollar index, and at the moment today, it's a bit unchanged from last Friday. We're at 103.1 today, but historically, we're seeing the U.S. dollar at some very high rates. And what is driving this? Well, what's driving this is the increase in U.S. interest rates. Every time the Federal Reserve increases interest rates, it increases the value of the U.S. dollar, and correspondingly, it devalues the other foreign currencies around the world. And in the wake of that, what that lets us do is actually export our inflation problem, and causes a lot of economic frustration from a lot of countries around the world. And in the wake of this stronger dollar and higher interest rates, this is the reason we've heard a lot more conversation about BRICS and an alternative reserve currency for world trade. I don't think that's going to happen, but what you're hearing is a lot of frustration. Now, the thing to keep in mind when you're looking at this U.S. dollar index is it's primarily driven by the euro and the Japanese yen. And while they're important customers, they're not the most important customers for U.S. grain and oilseed and agricultural trade. I've got a little table up there that's showing a few of the other currencies: the RG peso, the Aussie dollar, Brazilian real, Canadian dollar, and the Russian ruble. And those have significantly depreciated against the U.S. dollar over the last 2 years. Now, as I mentioned, the biggest driver and impact on that is the change in U.S. interest rates, and this is driven by the Fed. And you can see we're at a 15, 16-year high on current interest rates. Current expectations are the Feds will raise that another 0.25% next month as well. That's sort of pretty much factored into the marketplace. And every time that happens, that strengthens the U.S. dollar, weakens currencies, not only of our competing exporting countries, but particularly of the importing countries, as it makes food prices increasingly higher. And what we're seeing is importing countries particularly starting to do what any household would, is buying as they tighten up their food budget and fuel budget, and buy cheaper grain as well as buy less of it. Now, case in point, look at the Argentine peso. Came in Tuesday morning in August, and it had dropped sharply overnight. Argentina is experiencing nearly 120% annual inflation. The official exchange rate on the peso is about 350 pesos to the U.S. dollar, while the actual market rate is about 725, 730, as they're really struggling down there. Now, Argentina is an export competitor, and what this has done is made Argentine exports a commodity very, very competitive in the global marketplace. The other thing to keep in mind, the way an Argentine farmer, producer down there hedges against this type of inflation and market situation is they hang on to their commodities, whether that be corn, beans, wheat, cattle, whatever. They hang on to their commodity until they need to buy inputs for the next year. And a lot of companies down there will actually barter for that. You sell me your soybeans and I'll give you next year's inputs of seed, chemical, etc. And the Argentines historically have dealt with this over a good number of decades and are pretty good at managing these types of situations. Moving on to the Russian ruble, it's experienced a collapse that last week as well. It dropped to a significant 16-month low and a historically very cheap. This is on the back of declining oil exports as well as some increase in imports. And it's impacting the Russian economic situation. Just need an example of how our increasing interest rates and value of the U.S. dollar is impacting our competitors around the world. Now, I'm not really concerned with the Russian economy collapsing, but it is an indication that they're struggling a bit. And also keep in mind, Russia is the biggest exporter of wheat, and they're exporting more and more, or they like to export the wheat. It's more competitive in the world market with the lower ruble, but they struggle to secure the same amount of foreign currency. Good example of why they're sort of leading that push with China for an alternative world reserve currency. Then turning to China last week as well dropped to new lows, 7.2 yuan to the U.S. dollar. This is historic lows. The thing to keep in mind with the Chinese yuan is it is not a normalized currency, i.e. it doesn't trade. It is highly controlled and managed by the Chinese government, and you don't have a free flow of currency in and out of the marketplace. And that's the primary reason the Chinese yuan will never become the global reserve currency. It's just not normalized, and market forces just really don't drive that, although they do have significant influence. Just to look at China a bit closer, this is the Consumer Price Index, which when I worked there, we jokingly said it's a Chinese pork index. the CPI in China has a very, very high correlation with the price of pork in China. Keep in mind, nearly 2/3 of the world's pigs are produced in China. Also, we're looking at a significant drop in the purchasing index over there as well. And I think this is just other indications China is entering into a strong recessionary situation. And just this week, I'm reading we're expecting soybean imports in China to drop by 2 or 3 million tons, potentially even more than that. Again, what really drives soybean exports and imports into China are the pork and poultry complexes and demand there. Just to extend that a bit to some other countries that are sort of on the watch list that are, which I think the UN's put this data out as being in a precarious situation. We talked about Ukraine. Egypt's pretty much on edge. Pakistan had a collapse in their currency about 3 or 4 months ago. They're trying to figure a way out of that, but imports into Pakistan effectively dropped to nothing. Sri Lanka, about 6 to 8 months ago, their currency collapsed. Venezuela, it's been a perennial situation down there, and they continue to struggle. Countries that are on the edge haven't collapsed yet, but we're watching real close. Lebanon, sort of reflective of that Middle East situation. And then we have additional number countries in Latin America, particularly El Salvador, that we're watching. And then there's a number of countries across Central Africa, from Tunisia, Ghana, Malawi, and Zambia, that are on edge. And even though these countries may not be large buyers of grain, they do make a difference in the overall exports. The other thing to keep in mind, your major importers, like Egypt, is your biggest importer of wheat, and they're cheapest wheat buyers. And when our currency goes up, other alternative origins of wheat look significantly cheaper, predominantly the Black Sea, as well as wheat coming out of Argentina and Australia and other countries there as well. So being in the U.S., we don't necessarily think of watch the currency situation as closely as you do when you're overseas, but it is a big, big driver of the marketplace. What we're going to continue to watch closely is U.S. monetary policy. Are they continue to raise interest rates, and what will inflation do? I think we've had a bit of a respite here from inflation, but I don't think we're over yet. And I think we're going to continue to see interest rates and inflation move to higher numbers again. And with the higher interest rates, it's going to keep that U.S. dollar particularly strong. If you're an importer, it makes things cheaper, but if you're an exporter, it's just hard to compete. The key underlying issue on this, I believe, is going to be energy prices, particularly with oil. And I really don't have any direction on this. The key factor here is going to be Russia and their capacity to continue to export oil into the marketplace. They're going to be a swing factor in there. And then China, also, China's the biggest importer of oil and fossil fuels in the world. And those dynamics are going to drive that energy complex. And as we're all very much aware, for corn and soybeans, and increasingly for soybeans, that energy is a bigger and increasing part of those balance sheets. And we'll have a closer look at that here in a minute when Dan runs through those situations. Just quick 60 seconds on ocean freight. Ocean freight's another key factor. We've seen the prices come down from late 2021. They've tended to stabilize now. This is pretty much where we're at post-COVID or pre-COVID situation, as we see international trade of dry bulk goods sort of stabilize a bit. Keep in mind the biggest driver of dry bulk freight is iron ore and then coal, which together make up nearly 2/3 of the total dry bulk volume that moves. Grain makes up about 15 to 18% of that volume. The one thing I would indicate, you see this real record high number we had on dry bulk index back, this was just prior to the global financial crisis. And the dry bulk freight is a good leading indicator of international economic health. And we saw that rate collapse probably about 3 to 6 months ahead of actually the GFC happening. And one reason I watch this dry bulk index pretty close is it's a good leading indicator of economic health, particularly if we continue to have problems in China. If we see that drop off uh, to lower numbers, it's not going to be a good signal for commodity prices or the global economy. So that's sort of my comments on that. Dan, I might, in the interest of time, turn that back to you.
Let's take a quick look at the weather situation as we try to focus in on, especially on corn and soybeans and where things might go in those markets. Uh, so we've been looking at the U.S. drought monitor, giving us pretty negative signals for a good while now. And again, the drought monitor measures soil moisture depth, soil moisture at depth. In talking with the person that shepherds this out of the University of Nebraska Drought Center, so I asked, so does it measure topsoil or does it measure down deep? He said yes. Supposedly it measures both, but it's not exact from what I could tell. And I'm not being critical of it at all. We're thankful for it, but it does have more of a deep soil profile situation in it. So in the past, in Iowa, elsewhere, we've gotten pretty good crop yields, even with maps that look something like this. When we've had rainfall that's kept coming in a timely manner. Come into this year and 30 over the last 30 days, this was latest maps I had available anyway, through the 28th of August, 30-day moisture, and you can see in Iowa and to these other states, yes, some dry concerns, but not terrible. But then that's for the last 30 days, and then for the last 14 days, we saw really hot, dry conditions. You're catching that 100-degree time frame that came into play over the last 7 days. We've seen that even more. So you've got now coming from where we were to where we're at now, a sharply drier situation. Of course, the crop tour, the independent crop tour that came through these areas last week, caught some of that. They were standing out in the fields when corn and soybeans were having all that damage. So is it a game changer? It certainly has brought our attention back to potential crop risks here later in the year. Would just say overall, still enough dry conditions, over wet conditions around these different areas of the world. That's all to be of concern. We don't talk a lot about India, but India had dry enough conditions that it's impacted its rice, how it trades rice, and also wheat. And of course, we'd heard within the last several weeks of major flooding in key crop production areas in China. And Guy, in your old home stopping grounds in Australia, the La Nina impact must be starting to take hold. You see some dryness in the east and particularly the west in some important crop areas. Any comments on that, quick?
Yeah, Australia's had 3 years of record winter crops, wheat crops, and this year it's expected to be down, I think about 20-25%, just on, I'd call it more normal weather. But as we switch from La Nina to El Nino, El Ninos are always not good for the Australia situation. So their exports should fall off with the lower crop production.
You still see dryness in Argentina, southern Brazil, spottiness all over the place. So when we just pencil in great crops for next year, that's those things aren't a surety. Let's take a look at the corn markets. Certainly, we've seen movement in the market that if you're a seller, that you're bothered by. If you're a buyer, you welcome it. In terms of giving you more of a moderate priced input. But you can see we traded down in the last several days to excuse me, this is a weekly chart. Last several weeks traded down as low, as 473. Closed yesterday 486 and three quarter. This is for the D's contract. Had been earlier up to in 22 as high as 637, about 630 or so in about May, June. Uh, Longer term high for this contract 679 and a quarter. On the low side, it seems like a distant memory. There was a time in 2020 we were trading at about 375, and that just seems like a world ago. So just a lot of volatility and change in these markets. Interesting trends now. Now coming into harvest, you see the Salina corn basis uh, moving towards its 5-year average. That'd be the kind of pastel blue uh, trend that you see, line that you see there, and that this is a weekly basis. That at zero is even with the futures. 0.5 on the left. Over here, that would be 50 over, 50 under. We're moving from a positive basis situation down to an even money par move. A little stronger as you'd expect in the southwest parts of south central Kansas. A little drier in some of those areas, uh, and you can see a similar trend, but at a different scale. It did come out on August 11th. We had this supply demand balance sheet, and you all, as market watchers, this doesn't surprise you at all. You're familiar with all the stories here. The USDA did drop their yield figure from 177 and a half, pardon me, down to 175.1. And the question is, with the current conditions that we've seen the last several weeks, will that number come down? Um, See the production number, again, recovery from the year before, and down to 15.1. So you'll see scenarios later on where we're looking at how much we drop off from that 15.1 billion bushel figure. And you have all this usage. So when the USDA dropped 200 million on their earlier from their July production estimate, they did some rationing across different uses. And if we drop more, another 200 million, there would be the necessity probably of some more rationing. Probably, I think the biggest thing I can tell you on the corn balance sheet is that if you take 200 million bushels off of that, off the production number, and don't change the usage from the August number, you're sitting at still 2 billion bushels. If you go a little bit further and start to ration, you're still not far from 2 billion bushels. The big issue that came in here, it was in the June, at end of June acreage report, we raised the acreage figure for corn about just under 2 million acres planted, and that has pretty much put us in a situation where we have more of a, it's been called a cushion in the corn market, corn supply demand balance sheet. And when you see the market responding as it has last several days, it must have that idea in mind. Projected cash price 490 down from 660 this year. So even with a smaller 2023 corn crop coming from the July to August numbers, ending stocks 2.2 billion, still well above where we'd start to worry. And where is that? Well, you start looking towards 1.5 to 1.75 billion bushels. Well, then you have people's attention, and we're at 15%. When we get down to 10, that's generally historically a lot tighter situation. I just wanted to show you this. The market took in that DTN report, and but they'd said about they projected 172 bushels per acre for the United States as an average. Took a look at what happened Monday on this number, and although it was trending down for the good to excellent rating, it didn't drop off precipitously. So you could have in your mind the idea that that what happens every Monday afternoon in these terms of the crop condition ratings for corn is going to that's been revealed to be a indicator that the market's looking for. So stay tuned, and you can see where we're at. So are we vulnerable? Well, we're most of the way through doing. We're about halfway through denting. We have some maturity off to the south, so we're through all the reproductive stages. Now it's how we fill, how we finish the crop out, and hot, dry conditions could take the top off the yields in a lot of these situations. Interest of time, and just you can see that where we're at corn acreage wise, we are now at 94.1, a record high U.S. corn planted acreage. And we did have a higher harvested acreage back in 2016, but we're in those lofty areas. Would say that. So I'm kind of revealing my hand here. What my thoughts are. Um, Instead of the 175.1 that the USDA projected, or the 172 that the Pro Farmer Tour came out and projected, there's some history of the Pro Farmer Tour being pretty aggressive on those numbers. So thinking more of something towards the middle of that, 173.5 as a lower number. What's so right now, that doesn't surprise us. 2 months ago, we'd have guffawed at that. What are you even talking about? We have good conditions. Well, this is where we've come to. Um, this I think it's a fairly important chart. What's the final accuracy of these August 1st USDA forecasts? And last year we got the August 1st number, and that would be you can see that on the red line, the August 1st USDA forecast. That ended up being 2.1 bushels higher than the final number. We ended up and dropped from that. So, and you can see a history where there's a fair frequency going both ways, just depending which time frame you want to look at. But in recent history, not out of the ordinary that the August 1st report has ended up being high. And on August 1st, USDA is not out in the fields doing enumerated samples. The crop's too immature to do that. But here, have now entered into the time frame when they're out in the fields on September 1st and around that time frame when they're going out right now. The USDA staff are right now out in fields getting their yield estimates. So something to watch. Just to show you this quickly, you can see for Kansas, 124 bushels per acre as an estimate. That's a mix of dryland and irrigated, up 9 bushels from last year's drought plague situation. Note the Iowa number, 203. Again, that was the thing to remember about these. That was as of August 1st. And now we've got what's happened since then. So where will that number and these other numbers in these northern states go, given the tough conditions for corn that we've seen? So come to this situation where in terms of stocks and stocks to use, 2.2 billion, 15.3% stocks to use. So we're up in those lofty areas of about 15% stocks to use, and that's about as you're getting up near where we're at. And if you see down on the left, you can, again, we're kind of revealing my hand again. I think there's about a 20% chance that will stay there and probably see something lower. And so here, I think you have this handout in what was sent to you, and saying there's about a 20% chance that the USDA is right, 175.1, and then use my own judgment, about a 40% chance of something straddling what the Pro Farmer Tour had and what USDA said about 173.5. Still, if we stay dry, you're trending towards, it's a moving situation. You're trending towards that 172, and there's some chance of even going lower. But if you get down to 172 and 170.5 and start producing 14.8, 14.7 billion bushels of corn, you have to go into those usage numbers, and you have to start cutting back usage. So you have to start really impacting the price to the high side. And you can see down here on the bottom, 490 is what the USA is projected. And as you keep stepping lower and lower for production, you just keep adding about 25 cents, about 20 cents, about 25 cents to what you'd expect those prices to be. And you can see that here graphically. USDA's projection in the purple, and as you keep stepping down for the ending stocks to use figure, again, all driven by that production number right now. That's kind of where we end up at. Guy and I have talked a lot about this. This is the this is the world less China uh, corn supply demand balance sheet. Just let's see here. There we go. Um, it, it just strikes me that when I see that 110 uh, numbered 110 million metric tons numbered here at projected for this marking year that will have on August 31st, 2024, that we are just maybe, well, we're not even planting the South American, haven't started planting the South American crop in any earnest yet. So you're counting on normal, the good crops going forward, and if that doesn't happen in South America, given issues that we're wrestling with right now, then you just have a lot more rocky, volatile market that's just all that much more sensitive. And Guy, you and I have looked at this. Guy, do you want to have any? I guess for each audience, they probably heard us say it, but uh, the reason we kind of look at world less China's stocks numbers for these world approaches, just because we're, as opposed to world total that has China in, is just because of some of the vagaries of their accuracy. You want to comment on that?
Yeah, just you see China's there at with about 200 million metric tons of carryover stock, and there's a question of whether it's actually there or not. But whether it's actually there or not is it's not available to the marketplace if it's sitting in China. China's not going to re-export that corn, so you predominantly look at the exporting countries to see what's available to the marketplace. So it's not unusual to look at the world less China, or the world just at the major exporting countries in there. Now, the question is, China's become the biggest importer of corn here in the last 2 years. They're top one or two. And it surprised a few people when they started importing the volume of corn that they have. I'd suggest that 200 million is not there. It's probably less than 40 million. And I sort of put it in the context of China's where they're at with corn today is where soybeans were 25 years ago. And they're having to make resource allocations. And I think China is going to elect to import corn rather than import meat. I think they're going to import feed grains along with the soybeans for soybean meal, and produce that animal protein in country, with a particular focus on pork being the biggest, poultry, and then aquaculture is quite significant.
You uh, uh, just be ready for at that about that same slide to comment on their oilseed imports, but
Yeah.
we're not there yet. So, folks, I sure want to respect your time. We talked about 1 hour, so we're going to make sure we cover soybeans by 1 hour, and if others want to stay on here about those other crops, fine. But we want to do a good job on beans. So here's where soybean market has come to. Again, closed yesterday 13.92 and a half. This is the this is the November contract. Right, November 23. Right now it's down 7 cents, still about 13.85. And the pathway that we've taken to get there, we traded down as low as 12.82 here in the last few weeks. Had traded down to about 11.30 and a half. That coming in May, had traded as high, no doubt affected by all that was going on in the markets with the Ukraine-Russia war, as high as 14.48 and a half. And not that long ago, Guy, I guess I'm getting seasoned. I can remember when I was kind of excited about $8.50 soybeans, but that was only in 2020. So our frame of reference has changed. So why show this chart? Well, we've been moving to the high side. If we have further problems, well, the highest that these contracts trade at is a significant issue. So if you run up to 14.48, near 14.48 and a quarter, and we wonder where the market's going, well, if it breaks through that, keeps going, then someone has decided, we're in a different situation, and just something to keep track of. Basis. we tend to get a lot of summertime basis swings. And some of it's just because we have soybean, we have a July and August to September contract. We keep rolling through, but we also have had some volatility, some movement in soybean basis. So here in Salina and Export Center, you see maybe the biggest thing to see there is that here's the 5 year average where we tend to go sideways now. Last year we got to this point, we dropped off precipitously. We're at the same point as we were last year now in the red, and we're going higher. And out in Wright, which isn't in the middle of soybean processing country, strong move to the upside for soybean basis in that Kansas location as well. So out in the country, we're seeing some demand pull going on at the local level. Uh, I think that maybe the biggest number for soybeans is this one up in the corner, 83.5 million acres planted. That change that happened from year to year, most of that again came out in that acreage report on at the end of June, and just changed the dynamic. Uh, so 4.2 billion bushels, down almost 100 from the July number. That's what we had in August for U.S. production. Crush trending higher yet. I have a comment on that here in a little bit. And so crush trending higher, exports trending lower. That as you can see, ending stocks trending lower from 260 down to 245, and that number arguably is really at risk, the production number and the ending stocks number, and that's kind of the gist of our issue that we're looking at in these markets.
Hey,
Average market
Dan,
price.
I'm going to break in. Sorry. We
Yeah.
had a question. Sorry, I thought you were at a better breaking point, but do you think futures markets are trading under the impression that China stocks are actually 200 million?
This is under corn futures or soybeans.
Let's see.
Probably for corn. That's the
Came
one we're
in 3 minutes
talking about.
ago. Yeah.
I'd say yes. The trade doesn't believe the 200 million number at all. So I would, and the reason the market looks at world less China is they're effectively discounting that carryout number, and you look at the actual usage and production numbers to come up with your consensus. So that's my 2 cents, Dan.
I would agree. I think that you have informed traders, and now in our algorithm driven uh, trading environment, where someone who may or may not be informed sees that, gosh, the world numbers went up for stocks, and haven't invested to understand what's back behind that current situation. They may be affected by it, but but that's probably really a quick response. Eventually, the supply demand reality comes into play. So, is the market trading that? Most informed traders that are in there are not. There are a few that have probably a very speculative bent. They see a number, they might jump on that world number and just not know what it really means. Does that sound? What do you think, guys? That sound okay to you?
Yeah. The smart money in the market completely discounts China stocks
Yeah.
numbers.
So here we got a situation where a sharp reduction of planted acres on June 30th really set the stage for what's going on in soybeans. And for soybean buyers, soybean processors, they did not need what has happened in the last couple of weeks during a more vulnerable time for beans to come in and play. But again, same story. We've had these reports. The good to excellent ratings they've dropped, but not as much as expected. So again, I would just like for corn to see where when these things come out on Monday afternoons. That's going to be a big issue driving us forward. And you come down and see where soybeans are at, setting pods, dropping leaves. You can see the last 5 year average in the very dotted line. More vulnerable than corn to lack of rain, to high temps. So really sets us up to ask some questions. We've talked about the acreage number already. You've seen that. You can see the drop from year to year, almost 4 million acres planted. You can also see the kind of revealing my hand on where the where I think the number is going 49.9, 47.9, something like that. Uh, from where what the USDA had put out in August to where it might go in September. You can't see the yield for beans in Kansas at 35, up from our drought affected situation last year in Nebraska, up 9. So interesting to watch all that. So, and again, how accurate are these August forecasts? Well, just like for corn, we that the forecast that came out in August was about 2.4 bushels higher than we finally ended up, and current conditions are tending to trend that way. Now, if we were sitting in 2016, we would never be saying that, but we're sitting in 2023, and we've seen what's happened for 5 out of the last 6 years, and we're pretty skeptical. Uh, just without beating this to death, we can see U.S. exports of soybeans moving to the lower side, processing moving to the higher side. If you look, the Brazilian model for participation in the soybean market is to sell the raw beans. The Argentine model is to yes, sell some raw beans, but mainly process that and sell the meal. With the move towards renewable diesel, we're kind of moving. We're not there yet, but we're moving away from the export hard competition model to more of the to taking on more of the domestic processing side. Is that good or bad? Well, it just is what it is. People are following their economic incentives, I guess. This is where what the USDA has projected, 1270. And then you can see down there, I think there's about a 25% chance that they're right. and that's through that's because their number was based on what they could see on August 1st. So here you come in and put in scenarios of see about a 40% chance of about dropping 1 bushel, another 25. You could go further, 2 bushels, and things get really rough for beans in those key areas even further. So, and the key to me is that, again, you can take about 1 bushel lower, but you get much farther than that. You're going to have to really start rationing. You have to really raise prices to keep yourself above 100 million bushels. And you're down here to 2 and 3% stocks to use. And that's getting this brooms out to sweep the bins. So you can see this situation. If Brazil hadn't had a large crop this year, that number would be even higher. Basically, about $1.50, $2 higher, and we'd be having amazing prices for beans. So, but so you can see, I'm saying there's about 25% chance we have a 1270 and about 75% chance of something markedly higher than 1270 by the time all this gets done. Guy, another world minus China perspective. Would you want to, and again, same deal, get that red. We're banking on crops to come to really rebuild stocks that haven't even been planted yet. Comments?
Yeah, look, the soybean less China is not as distorted as the corn is. China for some time has worked those ending stocks down. They carry a 60, 90-day buffer of inventory there for the crush, but it's not nearly as distorting when you're looking at the stocks versus use. But again, I always question any sort of numbers coming out of China. But what we do watch and what I do give credibility to is their weekly crush and their weekly imports. And you can see what their crushing margins are. And then they have an auction process that puts government-owned beans back into that crush, which we watch pretty closely. But what I would say on China is 2/3 of the world's oil seeds go to China to be crushed. They are the market. With the declining economic situation there, I think that's impacting demand. And I think we could see China imports drop. Reports this week said 1 million metric tons. I think we could possibly take 2 to 5 million metric tons off their imports. And that will come directly, I think, off U.S. exports. Like you said, Dan, Brazil had a very big soybean crop this year. They're still exporting significant supplies of beans. That's extended their export season, and we haven't seen that switch logistically from South American origin to back to the North American supplies quite yet, or as early as we would usually anticipate.
Say, Rich, so we're at 5 till, and I know there's some people have to go, and we want to, for those that need to leave, we want to let them leave. Rich, can I suggest that we go ahead and open this up? And if people have questions on either sorghum or wheat or cotton, I can go there. But or if they have other questions on what we've just talked about, what would you think about opening up the floor and seeing where people want it to take
Sure.
us?
That'd be great. And I've opened it up so folks can unmute. So if you want to talk, go ahead and unmute it and speak directly, or else put questions in the chat.
Hi, Dan. This is Luke.
Yep.
Just a quick question about wheat. Perhaps this is just speaking off of sentiment and not hard data, but um, we see more and more that, I mean, input costs are going up, prices are coming down. There's nothing really to support the price of hard red winter wheat, it seems. And especially with yields, how they've been this past year and the year before, and feels like the year before that. I mean, you just seems like you can't make a buck on wheat except for insurance. So, what's your perspective on where do we go from here in terms of hard red winter wheat, especially in Kansas?
Well, this chart. Thank you, Luke. That dollar I promised you, I'll give that to you later. Okay. So that's exactly the question I wanted. But you can see the trend for wheat has been down of late, and it has a lot to do with the U.S. Standing in the world wheat export community. The guy you're what you brought about in discussion of the U.S. dollar as opposed to these other currencies, especially hurts us on wheat, just because there are more potential competitors to sell wheat to people, that and sometimes a lot better located logistically, particularly to hit the Egypt market or and Middle East markets. So we have seen this trend downward in hard red. This is for hard red winter wheat, uh, and uh, I at first I thought, well, gosh, it's genetics, but I don't think that's it. You know, when we even here in Western Kansas, we were fortunate, we caught some late rains, yield 60 to 80 bushels. When we have the moisture, we've been able to, benefit from the genetic improvement in the crops. I don't think it's on the breeding side that's as much of an issue, but but uh, the competitive just between crops, development of ethanol, now, frankly, development of oilseed crush, canola, elsewhere. All these are coming after acres that we used to just dial in for wheat in a crop rotation, and you can see this downward trend in wheat production. Uh, I would say, I think the next slide. Uh, uh, Wheat exports by class is just so telling that this currency thing is such a hitter for us. The currency issue, and okay, when the USDA dropped at 25 million bushels in terms of U.S. wheat exports from the July to the August reports, they took all of it out of hard red winter wheat and dropped hard red winter wheat now down below, down below white wheat, down below hard red spring, etc. So pretty hard hit. Um, and also coming out of Europe, some of the wheat that's come out of Ukraine. Uh, Countries there have passed laws. Basically, they won't allow that wheat to be sold in their country, Poland, others, but they'll allow it to pass through. So it passes through, and if you, I don't have the price charts up right here, but the price then is low enough to buy that wheat, and over there in Europe, transported across at very low, very low supported currencies, and then bring it over to the U.S. and provide some competition for that. So you have both the currency working against U.S. wheat exports and as a result, through no fault of any farmers that talk about these countries, but now we're importing wheat into the U.S. So you have kind of a double barrel hit on hard red winter wheat profitability. So my thoughts are eventually that situation over in Europe will rectify itself, and there won't be as much competition for wheat coming into the U.S. and we'll get better weather, all of that. But in the meantime, the hard red winter wheat enterprise in the United States in general and Kansas in particular really suffers. Luke, is that getting at what you're thinking?
Yeah, that's getting at it. So, in your opinion, are people just going to continue to substitute away from hard red winter wheat in the future?
They'll follow their economic incentives. We still need to plant hard red winter wheat. Yeah, we're building. There's a plant in Phillipsburg, a former ethanol plant, being transferred over, transformed over into a gluten plant, and they'll need acres, they'll need production. So there's still a need for hard red winter wheat, but but well, we saw the crop insurance numbers. We're providing less incentive in terms of a insurance selling price by about $1.40 a bushel coming into October, unless something changes, than what we had a year ago, and it's just less incentive, and you just keep bleeding away step by step to diminish the profitability of hard red winter wheat competitively.
Just 2 cents there, Dan. It's the market's being pretty clear on what it's trying to tell us. It's telling us soybeans particularly are quite competitive, and it's telling the Kansas wheat producer he needs to start raising soybeans if he can. And just to take it back to the corn soybean spread, that corn soybean spread's historically quite high today, and it's again what the market is telling us next year. It wants us to focus on soybeans. Trying to get the U.S. grower to move away from corn is it's going to take a pretty good incentive there. But wheats, there's no return on that. Just looking back to Dr. Featherstone's presentation on market returns, soybeans were ahead by quite a bit, and wheat was really lagging there.
And Guy, I don't disagree with you. I think that we see the decision right in front of us. What I wonder about is what the ramifications of that decision will be in 24, 25, and 26. So by the time we react, plant a lot of soybean acres, where will that leave us in the corn market? You've got there's an old saying you and I have talked about that when the agriculture and the industries in Kansas make money at something, what do they tend to do? We tend to destroy it. We tend to overplant and overproduce, and that's the market tending to rectify itself and bring us back to just enough return to keep resources in the enterprise. So eventually these same forces will probably help us on wheat, but right now again the high currency is really working again, and some of these other international geopolitical things are working against wheat, hard red winter wheat in Kansas.
Yeah, we've got very comfortable with particularly corn and soybeans. It's a bit more comfortable at your ending stocks numbers than it was a year ago, but we're still historically very, very tight, and it won't take much of a production problem or a shift in demand to move things. And that's why, any little bit of news in the marketplace, it just adds to this volatility. And it's, I think the last time we've had significantly high prices and hunger around the world is not real forefront in the residual memory of the marketplace.
They don't pay you and I to use hyperbole to get people all riled up, but boy, you couldn't be more right, Guy. You're only one or two short crops in these major producers away from driving yourself sharply down for ending stocks, and then people starting to get worried about again. Right now, we're at a 16-year low in stocks to use for wheat in the world on a world list China point of view, and there you go. It's we just sort of dance on the edge, but again, we're sort of myopic. We don't see a problem right now, so we're not going to worry about it, and therefore we don't have $11-12 wheat. So, any other questions? I see a question there. How long do you think we have from Ward? Hello, Ward. How long do you think we have before, if there is a significant reduction in demand for corn-based ethanol due to electrification of various modes of transportation? Guy, I have an opinion on that. Would you want to say your more reasoned opinion before I say my less reasoned opinion?
I don't know if mine's more reason. So go ahead, Dan.
I if it happens, it will be by regulation, and forced transformation of vehicle usage out in the country. And so many of these things are happening out of the state of California. They set like they're setting a goal for electric truck usage, all the trucks being electric by 2030, and all that, and they have the right to do that without question. There are probably economic ramifications. If you can't meet that standard, then how do you get food into California? Well, you keep raising the price, and uh, so I just hope that we're cognizant of the the stage 2 impacts of the uh, of the ideologically based stage 1 rules and regulations that we're putting out. Did I say that in a way that was acceptable? Do you agree with that, Guy?
Yeah, look, I'd concur. It's a bit of a pipe dream to think they're gonna electrify everything. It's impossible to do, and it's the only way to solve that problem is raise prices to a point where they either change their minds or they make it economically sustainable. Which that's a long way.
Yeah.
There's just not the infrastructure to do it.
I don't want to completely criticize those electrical vehicles. There's no doubt a place for them. It's a challenge to run them through the plains areas. You're pretty limited as to where you can go. Breakdown, repair are not cheap on those things. So that the transition, and I think they're banking on new technology to come to make all that cheaper, and it may. But as we sit right now, that I think you want to look closely at the assumptions and see whether we can really get to that or not. Just one last comment then on grain sorghum. Just be really, I don't know what to think about sorghum. We planted a lot of sorghum in Kansas. The acreage report rate added 500,000. Some of that probably on failed wheat acres from earlier. And in some of these areas, we've had moisture. No doubt, still variability across Kansas, depending if you have the blessed with moisture or not. Um, uh, Pardon me. There's a demand surge from China right now, and again, China dominates that U.S. Grain sorghum export market. They're purchasing it's a alcohol product. Guy, what's the name of that again? Do you remember?
Baijiu.
Baijiu. Thank you.
Yes.
So that is certainly there, and it's given a shot in the arm to grain sorghum, and I think we saw that in those forward contract bids. Some of those bids right now are higher than for corn for new crop delivery. It's probably because of that. In the long run, the corn or the feed grain complex has this Mexico trade issue to deal with, not easily dealt with. That demanding non-GMO corn for human consumption. I don't know. I think grain sorghum probably has a place in there. There was a time when most of what we sent to Mexico was grain sorghum, non-GMO, but there's a place for corn as well there. So I don't know how that will all play out, but that's a long run issue. I don't think that right. I don't suspect that right now is the issue that's driving some of the good new crop forward contract bids for grain sorghum. I think that's more the Chinese demand for Bijou.
Yeah, we've seen a bit of strength in the sorghum basis in the last month or so. Australia had a reasonable sorghum crop last year, and they finished their export program for the year. And most all that went to China, not unsurprisingly. So since they finished up, that's lended some strength back to the U.S. as China's returned to the U.S. market to buy their supply. The biggest frustration on sorghum is trying to get them to put a forward price out there so you can plan and produce that looking ahead with a bit more certainty than what we have just looking at the spot market.
I think we have it in Kansas. At you'll find some forward bids, but my friend colleague Mark Welch, Texas A&M, was at a talk with him of late, and whereas we were talking about what's a positive development for basis here in our state down in Texas, they have exceedingly strong grain sorghum basis bids. So it worked its way up to us as well, but down there where they closer to where they fill the vessels, that they were really hopping for sorghum. So interesting.
Hey, Dan, there was a question came privately to me that I sent to you.
Okay.
Could you explain what you mean? Do you see that?
Yeah. Could you explain what you mean by taking away from China's imports that would come off of U.S. exports? Guy, is that in reference?
That was my comment. It was more as China's import demand for beans drops. I think that'll tend to come off U.S. exports one for one rather than Brazil.
Yeah.
Is the point? It's that
have,
drop in demand is going to hit the U.S. first.
They have several motivations for doing that, no doubt. Some of them geopolitical, in that if they can go anywhere but to the U.S., it seems for some of their import purchases, they'll do that. But still, thankfully, they're able to buy from us.